Atención al pedazo de contenido que tenemos hoy en el canal, como siempre con referentes de Wall Street, en este caso Sam Stovall, que es estratega jefe de CFRA, una de las firmas de análisis que más importancia tienen ahí en Estados Unidos. Como titular, ya os digo, primero, no veo recesión en 2023 y tampoco la ve en 2024. Atento a sus palabras, también con respecto a la bolsa, lo clavó bastante durante todo el pasado ejercicio y este año dice que las cosas también pintan bastante bien. Así que atentos a todo lo que dice en la charla, está completamente subtitulada para que los hispanohablantes y los que no tengan conocimiento de inglés puedan seguir la conversación sin ningún problema. Así que ya sabéis, si os gusta el contenido, si os gusta la charla, que es fantástica y que nos deja unos titularazos, dejad vuestro like, dejad vuestro comentario y, por supuesto, si no conocíais al canal, suscribiros. Okay, here we go again with Sam Stovall from CFRA. How are you, Sam? This is a pleasure again to having you here and to talk about the current environment in the economy and the stock markets. Thank you very much again for being with me.
My pleasure, Hector. Good to talk to you again.
Thank you. So the first question I want to ask you is related with the next Federal Reserve meeting, which is right now. And last year, you told me about the expectations of no recession for 2023, and that 2024, the cycle was more positive. How do you see this year? Will it remain clear for economy, or your vision has changed? What's your point about it?
I don't think our vision has changed. We still believe that there is no recession ahead. We do think that the economy's growth might slow a little bit, but what do you expect after seeing the Fed funds rate rise by 5.25% over a 13 or so 16-month period? So I would say that yes, a little bit of a slowdown in spending, a little bit of slowing in overall economic growth, but that will be refreshing because we will be sidestepping a recession, in our opinion.
Related with the Fed meeting and the next steps by Federal Reserve, the market is discounting right now as many as 6 interest rates cuts by the Fed, but with no economic recession. Do you think there will be that many cuts if the labor market doesn't weaken somewhat, or what's your analysis with that?
No, my feeling is that the Fed will probably hint that it'll be later and fewer, meaning that they will start their rate cutting cycle later than the street is currently anticipating. The street's now looking for it to be in March. We think that it'll be May or maybe even June when they have their first rate cut. We think there will be 3 total rate cuts, 1 in each of the second, third, and fourth quarters of this year, not the 4, 5, or 6 that Wall Street is anticipating. And one reason is because we don't think that a recession is around the corner. If a recession were likely to be at hand, then yes, the Fed probably would have to start cutting rates early and do it 4, 5, or 6 times. But since we don't think that we're going to see that kind of a slowdown, we think continuing to expect that kind of easing would actually imply that a recession is around the corner.
Do you see the possibility of the QT ending this year? Because there are some information around that.
Well, I think that the QT will continue. The Fed certainly wants to unwind its balance sheet in a sense to therefore have more reserves available for the next time that it needs to be bailing out our economy. So I think as long as we do not have any kind of a credit crisis, the Fed will continue to quantitative tightening by selling off its bond holdings until it gets to a more appropriate level.
And you mentioned credit crisis, and I want to ask you, what is your opinion of the reverse repo facility drain? Can it affect regional banks from March onwards or not?
Well, I'm not a financial expert in terms of banking, et cetera. Our belief is that the Fed will continue to do what it needs to in order to bring inflation down. Our feeling is that inflation will be hitting the Fed's target probably sooner than anticipated. And if there is a concern, it's not necessarily that we're going to be having problems with a debt crisis, but rather that real interest rates will end up being higher than the Fed would like. So with Fed funds rates continuing to remain between 5.25% and 5.5%, but with the year-on-year percent change in core PCE dropping quite rapidly, we end up seeing a widening between interest rates and inflation, making the real rate steeper and therefore much more of a pushback against growth in the economy.
And do you think there are any risks to the inflation in the inflation court? Do you think it could be more inflation if the current situation in the Middle East and this kind effects or this kind of events could affect to the economy? Or what's your point about these concerns?
Yes, I think that is an outlier. That is a concern that we have that could upend a smooth economic transition over the next year or so. That should the tensions in the Middle East heat up, should there be efforts to shut off the Straits of Hormuz, continue to cause shipping to go around the Suez Canal and around Cape Good Hope, that that could be a problem because it could increase the time and therefore supply disruptions and also increase the costs. So again, we could be seeing COVID-like responses to the supply situation, which I don't think anybody wants at this point.
Mm-hmm. And what are your perspectives for labor market right now? Do you think there it's going to be more unemployment rate to this year? What's your target right now in the labor market for United States?
Well, our January target is for the unemployment rate to move up slightly to 3.8%. And we think that by the end of 2024, it could be around the 4.2% level. So still, a very strong employment picture. Remember, years ago, economists thought that 5% was the level of full employment. So with us still being close to 4%, I think that's pretty impressive. So that's one reason why we don't think that we're going to be seeing a recession this year, is because the employment picture will remain fairly healthy.
Mm-hmm. And talking about stock markets, I want to ask you about your target for the S&P 500. What is your scheme right now for the main index in Wall Street?
Well, our target is under review because, quite frankly, I set it too low. The thought being that once we get to that 5,000 level, usually large round numbers end up acting like rusty doors and require several attempts before finally swinging open. But 4,900 does not seem to have been a problem for the market. And right now, the target that I established in early December was 49.40. We're only 15 points away from that. And I think that for the coming 12-month period, the market will continue to do very well. Yes, we could very easily see a pullback, a 5 to 10% decline anytime in the year ahead. But I think that 12 months from now, we certainly will be higher than where we are currently. I like to remind investors that target prices are meant to be more of a weather vane than a laser beam, giving you the overall direction of the market rather than specifically what the actual percent change will likely be.
Mm-hmm. And talking about market breadth, what's your vision about the current situation in the stock markets, mainly in S&P 500? Because the market breadth has strength a little bit right now. We have the Magnificent Seven with a very percentage of the main index, and the rest of companies are not have so exposure to the index. What's your opinion about market right now? Do you think it's healthy for a stock market?
Yes, there are 153 sub-industries in the S&P 1500 index. That's the large cap 500 plus the mid cap 400 plus the small cap 600. And of those 153, more than each one of the indicators are above average when you look at what percent are trading above their 10-week or 50-day moving average, what percent is trading above their 40-week or 200-day moving average, and what percent are trading above both. And all three of those indicators are trading above their long-term averages. So while the Magnificent Seven does tend to get most of the attention, we have been seeing an improvement in the overall breadth. That many more sub-industries, that many more companies now in positive territory trading above their shorter and more intermediate long-term averages.
Mm-hmm. And which sectors can do better in this scenario?
Well, there's an old saying to let your winners ride. Frequently, people ask me, Sam, should I buy last year's winners or last year's losers? And I say that depends. It depends on what kind of a year we had last year. If the year was down, like in 2022, you want to buy last year's losers because they have the greatest upside potential. Yet following an up year, by sticking with the winners, you tend to outperform the market about 7 out of every 10 years going back to 1990. Of course, that's a guide, not a guarantee, but traditionally, you want to stick with areas like communication services, like consumer discretionary and technology. And if you wanted to add a final sector, it would be financials, because the three best performing sectors in the month of January, if January is up, tend to be outperformers for the entire calendar year. And that also is a positive sign for the likely performance for the market as a whole in 2024.
Mm-hmm. And are you positive with another assets like gold, for example, if we move forward to a scheme with no recession and cut rates? Do you think gold could be better for or good for performance in stock market?
Well, what's interesting is that gold prices, or the gold index of gold mining stocks, is the only group that on average posted a decline in the traditional 11-month period between the last rate hike and the first rate cut. Yes, lower interest rates do tend to help gold because gold pays no dividend and it actually costs money to purchase and store the gold. So usually lower interest rates are good. And also, if gold is priced in dollars, there does tend to be greater demand for it internationally. But I think that investors are going to gravitate more toward the growth areas of the market that are expected to post increases in earnings, double-digit gains expected to be seen for many of those sectors that I just mentioned.
Mm-hmm. And I make you just the last one, which is how might the election cycle affect to U.S. market?
Well, what's interesting is that there are two indicators that are very favorable during an election year. First is, how has the market performed during the election year for an administration that is up for re-election? And since World War II, it has risen 100% of the time, with the average gain being more than 15%. Also, looking at history back to World War II, whenever the market was up in January during an election year, it was higher for the full year 100% of the time, and the average increase was 15.6%. Again, not a guarantee, but certainly a very encouraging statistic.
Mm-hmm. So thank you very much, Sam Stovall, again to chat with me. It has been a pleasure to chat with you again, and thanks again for your points and your vision and your analysis for U.S. economy and U.S. stock markets.
My pleasure, Hector. Thanks for inviting me.
Thank you.